Hello everyone, and welcome to the Entrepreneurial Strategy Series. My name is David Postolsky. I'm an intellectual property and patent attorney at Gearhart Law. I've been one for about 21 years. I'm a big believer in education and empowerment, and so that's why I created this series almost 5 years ago. We've been going 5 years strong. And we call it the ESS series, and we cover topics from concept to exit in the entrepreneurial journey. This particular event, actually, we're super excited because this is the first time that our event is being sponsored by a brand. The company that's actually sponsoring it is a company called Kickoff. Kickoff is a low-cost credit building company designed to help people start building credit in a simple, low-stress way. We're excited to have them as a sponsor of this event and future events. Anyway, let's get into the formal presentation. So this particular topic, as you heard me earlier say, we get a lot of questions as IP attorneys that represent startups and entrepreneurs about all the topics that we're going to talk about today: funding and fundraising and finance and taxes and entities and all sorts of different things. So we brought on two experts, and we're super excited to have them. I'm going to let them introduce themselves for a few minutes now. The first one is Robert Pesce. He is here. Robert, let me spotlight you and take a moment to introduce yourself to the audience.
Thank you, David. Can everybody hear me?
Yeah, we can hear you.
Good. Okay. Well, thank you. It's nice to be here today. I'm a managing director at CBiz. CBiz is a large accounting firm, the seventh largest accounting firm in the country. I specialize in working with entrepreneurs, privately held businesses, people like yourselves who have a burning desire to do something and be successful in it. And I help them with all their accounting, business advice, and ultimately tax planning and tax preparation. We have people all around the country that do that. I lead the country's practice on that, and I'm based in New York, but talking to you today from Boca Raton, Florida. Nice to be with you all.
Amazing, Robert. Thank you for that introduction. Our second speaker, who I'm also super excited to have, is Mitch Fillet. Hold on, Mitch,
Oh,
welcome. Tell us
hello,
a little bit about
everybody.
yourself. Where are you? Who are you? Tell us.
Okay, well, the where I am is nowhere near as nice as Boca Raton, Florida. I'm in New Haven, Connecticut. Um, the My journey started on Wall Street. I went from a trading desk to a sales job to an investment banker. I wound up focusing on structured finance. The portion of that was mortgages. And when the mortgage crisis hit in 2007, I found I still had a parachute left over from my days in the military. So I parachuted onto campus, and I've been teaching. I taught a fair amount before that, but I'm now a full-time professor. My latest gig was at Rutgers, which I left in June. But I'm interviewing for three different teaching jobs. So I imagine I'll be back teaching in August. But at the same time, I've been advising a lot of startups. We got one public back in May, and I'm working on three others that are in various stages of running from the idea all the way through funding into actual kickoff of a business and reaching for revenue.
Excellent. Yeah, we're going to get to all of that, Mitch. Thank you so much for the introduction. So by the way, I love the AI reactions. That's awesome. So thank you for that, everybody. Robert, let's start with you. Let's start at the beginning, right? You heard some of the people that were here, founders just starting out, need to raise money, just trying to understand what's first, what's next. Maybe you can talk a little bit about what usually we recommend as lawyers, other than protecting your intellectual property, but the next big step is choosing an entity. Like can you break that down a little bit? What types of entities are there? What's the right choice for people? You heard a bunch of people say different things, 501(c)(3)s, and I have a company, I have an LLC. Maybe you can break that down for us.
Yeah, sure. That's great. Great way to start. So most people start out just by default as sole proprietors. As soon as you start your business and you're receiving money for what you do or sell, you are a sole proprietor. And that's generally the way people get started. You can form an entity immediately if you like. And the first entity that most people would form, I would think the choice would be LLC, limited liability company. Um, the taxability of an LLC is this identical to the way it would be if you were a self-employed sole proprietor. The IRS basically considers a single member LLC a disregarded entity for tax purposes. So it's the same as it would be if you were not an LLC. LLCs, of course, has some legal protections, which David could get into. But the, um, the sole proprietorship or single member LLC is generally the first step as somebody who's forming a business or starting a business. There are other entities to choose from. You might have somebody in the business with you. If you do, maybe you want to have an LLC with you and your member, also thought of as a partner, and that LLC would have be treated as a partnership for tax purposes, unless you chose to ask the government to treat you as a corporation. It's a simple election to do that. So now the LLC is treated as a corporation for tax purposes. That's another type of entity, of course, and a popular form of corporation is S corporation. So the corporation can elect to be treated as an S corporation. S corporations basically file tax returns the same way a partnership files a tax return. The S corporation doesn't pay taxes on its profit. Profit is taxed at the shareholder level, just like the profit is taxed at the partner level for an LLC that's treated as a partnership. So you got sole proprietorship, single member LLC, multi-member LLC, S corporation, C corporation.
Can you talk a little bit about the C Corp or Inc. as as some people may know it?
Yeah. So C corporations or Inc. That's generally it can be attractive to investors. Investors like to invest in C corps because of the fact that it's not a flow through entity. There's no limit to who can be an investor and how many people can be in it. There's really no limitations to that. Um, and there is something that is called the qualified small business stock provision, which is attractive to people who are starting a C corp. Basically, in the short in a sentence, it allows founders and investors to exclude the gain on the sale of the stock if it meets certain requirements. So it's a very popular entity choice for that reason. C corporations pay a flat 21% federal income tax. That's the rate that was passed in 2017 under the first Trump tax law a few years back. And of course, it pays taxes on at the state level for whatever states it's doing business in.
Yeah, those are good points. And I'm going to come back to you on some of that. But Mitch, I kind of wanted to know from you because most of the people I think on this call will probably be needing to raise money.
Right.
And as a result of that, what have you seen has been the entity of choice, from your experience?
Well, I like to pat myself on the back a little bit. I've helped over 100 companies get funded and starting up. All of them transitioned into or started as a C Corp. And what you'll discover as you go out into the world and you're essentially asking people for their money, as an investment, as a loan, even a financial institution, you'll find that they prefer C Corps to other corporate forms. And if you start to reach for a big pile of money, you'll wind up almost having to convert to a C Corp, which is not that hard to do, by the way. But I always say, and by the way, starting a C Corp is way easier today than it was 20 years ago. So I always tell people, start where you want to get to. It's kind of like what Robert Goodwin said. What got me to here today doesn't necessarily get me to tomorrow. So so effectively, start as a C corp, open up your bank, get your EIN, open up a bank account. Don't go to some little off-market bank. Your investors will feel much more comfortable if you're at Citibank or Chase or Bank of America or TD Bank, for instance, than if you're at Royal Palm Savings and Loan down in Palm Beach.
Yeah, Mitch, there's actually somebody, I have to ask this question. Becky wrote, what constitutes a big pile of money?
Um, well, that's a good question. I guess that target keeps moving,
Right.
but 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 you can start up a company today with $500 in the bank, right? That's obviously not a big pile of money. Somewhere along your journey to really build out the enterprise, to create marketing data and marketing procedures, and then fulfillment procedures, and then inventory, you're going to wind up needing $250 to $500,000. So my definition of a big pile of money starts with $500,000. And it gets to that's a big pile. A really big pile is 5 million, and a world-class pile is anything north of $10 million.
Okay, that's fair. And Robert, I think, I actually have the same advice that Mitch just said, which is like if you are raising money, you definitely want a C Corp. It is the preferred entity type that investors want. And so I usually tell them it's usually because of tax reasons. Can you kind of break that down a little bit? Like, what does it mean for an investor to invest in an LLC as opposed to investing in a C Corp?
Right. So if someone invests in an LLC and the LLC is profitable, the LLC's profit gets allocated to the investors in accordance with their ownership percentage or in accordance with the operating agreement that says how much the profit's going to be allocable. So let's say there's $1 million profit in an LLC. There's 100 members, and let's say that they're just by sheer luck, they're all equal members. That's kind of unusual, but they're all equal members. They all will get an equal share of profit that they have to pay taxes on, but they may not get the money. The LLC has to have a provision in it that distributes the profit to the members. And so sometimes the members will have taxable income that they don't have the money to pay the taxes on. So that's not a favorable thing for certain people that might be a passive investor in the entity. The C corporation, they make the investment, the corporation makes a profit, the corporation pays taxes on that profit, and if there's extra money, it can pay dividends to the investors, or it could just keep it in retained earnings and continue to invest in the growth of the entity. On the other side, if there's losses, if it's an LLC, those losses are reportable to the members of the LLC and passed through to them on a K1, which that's the form that the LLC issues to the members of the LLC. And those losses can be deductible on the individual investor's tax return, depending on certain rules, whether it's passive or active, or you have basis that's a little bit more complicated than this conversation is going to be about. But the point is, losses or profits get passed through and reportable on the investor's tax return. In a C corporation, if there's a loss, it's a loss. The loss gets carried forward indefinitely to the future years of the corporation, where hopefully the corporation makes some money. And in those years where there's profit, those profits can be offset by the losses that are carried forward from prior years.
Okay, awesome. Thank you for that. By the way, if you have any questions at this point in time, just chat them, but we will have a question and answer session at the end. And so maybe save some of your questions if you have any for the speakers. Mitch, did you want to comment on any of that?
Yes, if I could. The
Yeah, please.
part of the secret sauce of raising outside capital, from investors or financial institutions, which includes private equity funds, hedge funds, if you get big enough. The secret sauce is that behind the person or people you're speaking to is employees of the entity. They could be the person, if you're dealing with an individual, it could be their tax advisor, it could be their lawyer, their financial advisor. You don't really know what they're saying about corporate form and potential losses. But I can tell you this, if an advisor thinks that your enterprise has a lot of risk, they're not going to come back and say, "Oh, let's be an S corp so you can or an LLC so you can flow through some of the losses, they're they're going to say thanks, but no thanks. So, if Morgan Stanley just issued a report that said that they thought that investment in private enterprises was going to be up about 25% this year over last year. So there's a big pile of money out there looking to invest in young companies and startups. And a young company I defined as, obviously a company that started recently that is still growing revenue and profitability and cash flow at a fairly rapid rate. So so there's all this money looking to do something other than sit around in stocks, um, and certainly not wanting to be in a bank and get paid 2%. So
Right.
it's much easier today to get something funded, but you have to understand that you're only dealing with the tip of the spear. You're not dealing with the whole spear. You've got to build something that has real sustainability, conforms to good business practices, and that's why I always say go with a C Corp. Plus, it does provide you, as the senior management, with a little bit of legal protection because the corporation, if something goes really ugly, corporation gets sued before you get sued.
That's right. I think those are also to your point and to what Robert said before, making a decision as to what entity you are taking into consideration is not just a tax question, but it also has legal kind of ramifications as well in terms of liability and documentation. We're not going to get into that per se, but you should think about those considerations as well. Mitch, I'll stick on you for a second, but Robert, I want to hear from you on this question as well. Okay, I decided on a C Corp. I decided on LLC. Where am I creating this entity? What's this, Delaware thing? Like, do I really have to do it in Delaware? Like, what's your impression of that?
So you want my answer?
Yeah, yeah. I want your
Uh,
answer, then Robert can kind
all
of
right.
weigh in from a tax perspective.
Joe Biden says pick Delaware. The the cheap seats is Wyoming.
Yes. Yeah, no, and so do you think there's so in a nutshell, would you agree that you don't necessarily have to be a Delaware C Corp in order to attract investors?
Not until you get ready to pull the pin and go public.
Got it. Then you should be in Delaware at some point.
Yeah, probably because if you're dealing with a reasonable investment banker, meaning Raymond James or a Merrill Lynch, if you get really lucky, they're going to have a preference for a Delaware C Corp.
Got it. And so, Robert, do you have any perspective on this from a tax perspective? I mean, clearly, if I'm setting up in Delaware, I'm paying taxes in Delaware, but I live in Florida. So how does that work?
All right. So forming an entity in Delaware does not necessarily cause you to have to pay taxes in Delaware.
Okay.
So I usually tell people when they ask me, I'm starting a company, where should I form it? Let's say they're talking to me from New York and they're going to be doing business in New York. That's where they live. That's where they work. It's going to be a New York activity. I say to them, they say, what about if I form it someplace else, like Delaware? I said, well, you can form in Delaware. Delaware has an annual franchise tax filing requirement, which is basically a fee that you pay for the privilege of being incorporated in Delaware. It's a pretty low cost fee. Do it online. It takes 5 minutes once you know how to do it. It's not a big deal. The reason that I tell a client to choose Delaware instead of, in this case, New York, is because I'll ask them another question. Where do you think you're going to be living and working in the next 5 years from now? And they say, well, I'm thinking about moving to California. I'm thinking about moving to Texas, someplace else. Forming in Delaware gives you the entity some portability. If you form it in New York, and then 5 years from now, the business and the individual moves to, let's say, another state, that entity is going to continue to be required to file returns in the state of New York because that's where it's incorporated. It may not have any allocation to that state, but there's going to be a continuous need to file an actual tax return in that state that they incorporated in. So if you think you're going to move around, I tell them, form it in Delaware, and you can register the business to do business where you are right now in New York. And when you're ready to leave New York, you can withdraw from New York. You're no longer stuck to filing in New York, and now you can register the business wherever you now are relocating to, and start complying with that state's filing requirements.
Got it. Yeah, that's smart. That's smart advice. And what about if they're doing business in another country? Can you talk about a little bit about that?
Yeah, doing business in another country. You want to talk about that first, Mitch? You have any thoughts on that?
Yeah,
Okay, so you
Mitch,
want
you
me
want?
to you want me to tee this one up?
If
Yeah,
you
yeah,
don't
you can
mind.
tease. Go for it.
Doing business in another country adds, as an American passport holder, adds a level of complexity that's going to cost you money. There's just I've never seen anyone able to figure out a way around it. And unfortunately, it does leave you susceptible to some issues that come up that are, quasi-political, but have a major impact on your finances.
Okay, can you break it down a little bit more?
Sure. I mean, you decide you're gonna have a major operation in England and you're gonna have an office in London. There's a whole bunch of English regulations that are going to bear down on your profitability, and you've got to understand that, right? And if you don't, eventually they'll knock on your door.
Yeah, that's right. I mean, most nations in the world have, tax treaties with the United States to avoid double taxation and stuff like that. But of course, if you're going to do business in another state, you probably should be seeking, some sort of accounting, some sort of accountant that is in that country where you're actually doing business. Robert, would you agree?
Well, I can tell you that what Mitchell said is correct. There's definitely some complex complexities that have some costs. First of all, if you're going to form a business outside the United States, located someplace outside of the United States, you're going to need to engage legal counsel and accounting help with people that are local so that they understand the rules that are applicable and comply with those rules. Also, a U.S. entity that owns entities outside of the United States has some very complicated U.S. reporting requirements that have not just complexity but also some tax consequences. So I have clients that have done this, and it's definitely in their case it was necessary. I can also tell you that once they learned about the complexities, they looked at where they were, and instead of having 5 different locations in various parts of Europe, they trimmed down to where they really needed to be so that they could minimize the economic consequences and administrative consequences of that decision.
Got it. Okay, what about the reverse?
David,
Yeah, go for it, Mitch,
I'm
please.
sorry. Would it be okay if I shared a short war story?
Yeah, yeah, of course. By the way, Mitch, you're breaking up a little bit here and there. So just maybe check your Wi-Fi connection, but yeah, please share the
Oh,
story.
well, yeah, no, the weather has totally
Yeah.
destroyed every bit of electronic connectivity up here. I literally live on a hilltop over the beach, and it's old wiring. And to make things worse, our service provider got bought by Verizon. So I'm in a world of hurt. I'm sorry.
Okay, now please share the war story.
All right. So I'm an advisor to a real estate fund located in New York, who 100% of their investment was property in Iraq, in downtown Baghdad. And they sold all the property. The money was in Chase Bank in 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 Baghdad, and all they had to do was give Chase an order to move the funds to New York City. But the funds were in dinar, and there had to be a dinar dollar conversion. And because of the amount of money, it required approval by the government. The government retained Chase to help them increase the value, less than a dime at that point. And so it would have been, billions and billions of dinar. And so Chase froze the account. They had to legally, and it's still frozen. So if you're going to do business outside the United States, you're going to So you're going to have to set up a whole nother system of legal advice and probably accounting advice.
Right. That's right. What about the reverse, Robert? We ha you heard the makeup of the people on this call. Many of them are in other countries looking to do business in America. How does that work exactly?
Yeah, so I have clients that are abroad that are not American citizens or taxpayers. They have maybe a business already that they've started in their country that they reside in, or not. Um, but they can form an entity in the United States. That's certainly allowable and doable. That entity would, they would choose the right type of entity, probably a C Corp in this case. I think that's probably the best choice of entity given the circumstance we're talking about right now. And that entity would need to get an EIN, an employer identification number. That's good for that corporation. And they would apply for that on something called an SS4, the way anybody else would, except if they're not a U.S. resident and they don't have a U.S. Social Security number, the government's going to require that application be done by phone, and they'll need a third party designated authorized person to do that. Somebody who's got the ability to fits the requirements, is a U.S. taxpayer for tax purposes, U.S. resident for tax purposes. So it can be done, and it is done. The bank, which is another part of the question, the bank will also require somebody who's in the U.S. to be responsible for the account. But it happens all the time. Absolutely.
And Robert, do do you provide those types of services for foreign-based companies that want to do business in the United States?
I have not done that, but there definitely are people that, yes, they do. If
Okay.
I had a long-term relationship with a client that was international and they were a good client that we understood their business and understand them as individuals, and they asked me to do something like that, yes, we could do that. But generally what happens is we'll hear from somebody that we've never met from outside the United States. And if that request is asked of me, I generally will just say no, thank you.
Yeah, that makes sense. I probably would do the same thing. Mitch, what about you? I mean, you probably have provided mentorship and counsel to foreign-based companies or non-US citizens that are trying to do business in America. Can you share some experiences there?
Well, the non-US enterprise trying to do business here, to me, is actually a fairly easy proposition. Start up
Okay.
a C Corp, have the C Corp buy whatever it is you want to sell over here in the US from your foreign entity, and figure out how much profitability you want to leave where your foreign entity is domiciled and how much profitability you want here. All right. And I know that works because that's what ExxonMobil does. So that's sort of an easy process. The process of being here and distributing whatever your goods or services are in another country is not that hard to do, especially thanks to the internet. But you are going to have to become the master of the business practices of the place that you go to. And you can't just ignore it. You can't just say, well, I'm just selling stuff over there, because it's not what you know that hurts you, it's what you don't know. It's that odd notification that you get through email, or as they say, in the FBI, the 2 a.m. knock on the door. It's whatever you're not waiting for, that's what you have to anticipate. And that's where good financial or management practices comes from, is understanding what the process is that you're now going through and figuring out what you do to be the master of that process management.
Right. And what about that same company wanting to hire employees in America? Have you seen that to be an issue? Again,
Um,
we're talking about non-US, we're talking about foreign companies that are trying to do business in the US and also trying to employ people here.
right. I mean, honestly, I've never seen a foreign company do that. They always start up something here. You know,
Yeah. And
they,
then,
Right.
right. And then that's the entity.
they may sell a product or service here, but they sell it to Walmart. Now I'm done. right?
Yeah.
But as far as building a business here, I've never seen a foreign company not set up a C Corp.
Robert, did you
I
want to
agree.
comment?
I agree. That's how it's done. And what Mitch was talking about, managing the profit of this U.S. C Corp, the U.S. C Corp and the foreign entity would have some agreements between each other that where there'd be fees or whatever charges between the two entities that would minimize the or would manage the profit that the U.S. company has and minimize the U.S. taxes. And that's done in certain, it has to be done in a certain way, transfer pricing rules and agreements that have to be done between the two entities, but it's definitely doable. But yeah, the employees, if you need to have employees in the United States, they should be employed by a U.S. corporation.
Okay, and so we set up this U.S. corporation, whether we're a foreign company or we're based in the United States. We'll just say a C Corp for now, but maybe the answer changes if it's a limited liability company. And I'm trying to sell, I'm trying to raise money. I'm trying to sell product. I'm not doing any of that. I haven't raised money. I'm operating at a loss. Do I even need to file taxes at that point?
Yeah, I'll take that one. Yes,
Yeah.
if you're an entity, if you're a C corporation that has activity, and if that activity results in a profit or a loss, you have to file a tax return, and you should file that tax return, especially if it has a loss, because that loss is valuable. That loss can be carried forward to future years when the entity turns around and starts to show a profit. So you want to get that loss memorialized in a tax return and file it appropriately accordingly.
And does the answer change if I'm a limited liability company or a sole proprietor or a 501(c)(3)? Does it change?
I think it's the same answer. So if you're a limited liability company and you're having a loss, and let's say it's you and your partner, this loss doesn't get carried forward at the entity level because we know that losses pass through to the members. So you, as the individual, will be able to benefit by having that loss pass through to you on your personal tax return, and it'll be able to be used to offset your other income that you have on your personal return, such as interest, dividends, wages, your spouse's income, interest, wages. It's definitely a valuable thing, and the only way you get that is by filing the return and issuing the K-1s from the LLC to the members that shows that loss that they can deduct on their tax return
Got it. If they're an LLC in that hypothetical.
if they were an LLC in that hypothetical.
And by the way, there's a few questions that have kind of come in. I haven't been ignoring them, but I think people kind of want to know specifically like what is the difference between an S Corp and a C Corp? Like maybe you can kind of
Yeah,
give us,
yeah,
yeah, because I think that's important because it's usually a tax difference, but maybe you can break
yes.
it down. Yeah.
Well, what I just talked about a minute ago with the LLC, everything I just said would be the same for an S corporation. So S corporations and LLCs are flow-through entities. They do not pay taxes on their profits. The profits that they realize gets, instead of taxed at the entity level, it gets passed through and reported onto the owners, shareholders of the S corporation, members of the LLC. That's just different terminology, but it's the same thing. They issue a K-1 that reports the profit or the loss to the shareholder or the member of the entities, and that's different than a C corp because a C corp is not a flow through entity. The C corp profit or loss gets reported at the entity level. If it's a profit, the entity pays a 21% federal flat tax rate. If it's a loss, it's just a loss that sits there and gets used in the future to offset future corporate profits.
That's awesome. Hopefully everybody, and there was a few questions, so hopefully you're getting your, because people are like, oh, would you recommend an S Corp or a C Corp? But I guess it really depends on a variety of factors, right? Wouldn't you agree?
Yeah, I would. And I know Mitchell, has an interesting perspective on it. You just start where you want to be eventually. In his case, he prefers C Corps, and that's for good reasons. Most of my clients are not attracting investors. They're individually owned family businesses that are not looking for investors. And in that case, we usually advise LLCs or S corporations pass through entities because of the concept of double taxation. C corporations pay a flat tax on their profits, and any money that the shareholders take out of the company is considered a dividend. The dividend is not tax deductible at the corporate level. So the dividends are taxable at a preferred rate to the individual who receives those dividends, but there's tax twice. There's tax at the entity level, and then what's left over gets passed over to the shareholder and is taxed again. That's definitely double tax. It may not be as expensive or less expensive than an S corporation. You have to look at the analysis, but in an S corporation, if it makes a profit, there's no tax at the S corp level. The profit passes through to the individual, and the individual pays income taxes based on their individual tax rates, which can be anywhere from 0% to as high as 37% on a federal basis. It's a progressive scale.
Yeah, and just to close the chapter on this, Monica's question, I want to take it also because it's really on point. From an operational standpoint, outside of taxes, would you see any other benefits for, doing an S corp and or C corp or an LLC?
Operationally, I don't think there's any real difference. Operationally, the entity it gets formed, it needs to get an EIN, it needs to get a bank account, it needs to file a tax return, it needs to employ you as the shareholder if there's profits and you're actively involved in the business. So operationally, it's really very much the same. Do you agree with that, Mitchell?
Well, so let me validate your expertise here, Robert. The there's really kind of two animals that have entered into the conversation. One is the business is up and running. You may want to grow it, but it's a family business. You're taking over the family, restaurant. And there, a flow-through entity might be very, very helpful, very applicable, and sort of the right financial strategy. If you have an idea and you're going to use other people's capital, or mostly other people's capital, to boot up the idea with the hope that in 5 years you're going to list on NASDAQ, you need to be a C Corp,
Yeah.
right? Because and the great thing about the C Corp is number one, it does protect you legally to at least to some extent, and number two, the losses can be carried forward. So if you're right and your view of the future is relatively accurate, having losses for a couple of years that you aren't flowing through to your personal taxes isn't all that important because 4 years from now or 3 years from now, when the company's really starting to book, revenue, positive cash flow, and maybe even some profitability, those losses can reduce the taxes, the corporate taxes that the entity's paying.
Yeah, excellent. Yeah, Robbie, any final comment on that?
No, I think what Mitch said is
Yeah,
right. You got to look at the situation on a case by case basis. But
right.
in general, C corps are absolutely essential if you're talking about raising money and hoping to go public or grow institutionally. Absolutely.
Yes, I totally agree. Let's stick on that. Let's talk about raising money. Let's talk about investors. Everybody wants investors, right? Everybody, I mean, most of the people that you probably heard earlier probably need some sort of investment. But big question. We get this all the time. How much is my company worth, right? Valuation. I want to hear from you, Mitch. How should a founder with little to no knowledge, or even the little to no financial knowledge, or possibly has the most financial knowledge, how would you counsel them to approach the subject of valuation, which would then determine how much investment they're looking to get?
All right. Well, there's two levels of valuation. I'll leave the, hey, we're going public valuation to the licensed entity that's going to take you public because they're going to have a very strong opinion. Before that, as you seek outside capital, you're going to go through a series of discussions, right? And those discussions are eventually going to end at valuation. It's going to start with what's your product, who's your competition, what's your pricing like, packaging, delivery, your warehousing. A smart investor is going to take you all through your process, and then you're going to get to valuation. And luckily today, there's all sorts of data available for valuation. So what I tell people is go find some publicly held companies that are in your industry. They're as close to your spot on sector as you can get. Look at how they're valued, right? And even though they may be way bigger and they've raised a ton more money, it doesn't mean you can't use them as a benchmark.
That's
So,
right.
right. So if you have this company that's now public and it's worth $1 billion and all it's doing is producing losses and it got its sales up to 100 million, so it's trading at 10 times sales, and you've got your enterprise that you're starting up and your projections are that in a year you're going to be doing 200,000 in sales. Well, it's not crazy to say, look, I think the company's worth 2 million, 10 times projected sales, but our sales is going to be on a pretty big growth rate. So we're going to do a present value analysis of the next 3 years of sales. We're going to add that to the 2 million, and I think we're worth $20 million. And we're going to raise 5 million by selling off 25% of the company.
Okay, so let's carry that through. That's what this company's doing, let's say. And so now they just got, you know, a few 100,000. We won't even call the full. They just got a few 100,000. Any counsel or wise words to founders that, get a cash infusion after coming up with the valuation as to how that money should be handled?
Well, that's chapter two. All right. So chapter two is don't go down the slope of the crazies during the dot-com boom, right? So for those of you who may not have studied this, I was intensely involved in advising technology companies between 1990 and 2000, which took in what was called the dot-com boom in America, where literally you could have an idea, you could point to substantially higher sales in the future, do a discounted cash flow analysis back to the present, multiply that by 50 times, and get a $200 million valuation and go public and sell off 25% of the company and raise 50 million.
Right.
What a lot of management teams did for chapter two, because they didn't really have good management backgrounds, was they got masseurs to come in during the day to relieve stress, and they developed a pet excuse me, a pet bar so you could bring your dog to work, and they had a game room with a beer keg, and lunch was catered 2 days a week. And all of a sudden, a million or $2 million disappears. And it doesn't seem like much till you miss your sales targets and you
Right.
need capital, and then you go to a bank and you go, well, we raised 50 million and we have a $200 million valuation and we'd like to borrow another 20 million. And the bank looks at your financials and says, you threw away $2 million on fun. We're not going to loan you money. You're a bad management team. So a lot of it's sort of like playing on the JV and trying to make the varsity. You got to be really, really structured as to how you protect the outside capital, how you use it, how you drive forward to produce increased revenue and increased cash flow. And if you miss your targets, that's okay. Failure is acceptable so long as you can explain it. Right. So failing the masseur, that's bad, right? We went out and we built a product and we thought that consumers would buy it at $22, so we sold it to the retailers for $11, and it turns out the retailers got pushback and they only sold it for 18. So we had to reduce our price to the retailers to 9 so that cash flow was reduced. That's okay. That's the answer. Your management, especially if it's someone else's money. If it's your own, have fun. But if you're going to raise outside capital, you've got to, every day, you've got to wake up and go, I'm going to the arena and I'm going to play the big game today. Every day. Because someone will eventually hold you to task, guaranteed.
Yeah, that's right. I love that. That's great. That's wise words, Mitch. I agree because I think all of a sudden founders get like influx of of money and don't have a proper plan for it, and it's a problem. But speaking of that influx of money, Robert, so here I am. I was, operating at a net loss. I just got $500,000 investment. Is that considered income? Like, do I have to how does that work from a tax perspective? Am I paying
Well,
tax on $500,000 to like on the day that I like in the year that I get it, or is there something creative I can do?
if it's an investment, if someone's investing $500,000 in your company, it's not income. It's you sold equity in your company to the person who's paying you the $500,000. Question is, what percentage of the equity did you sell? And that gets back to valuations. And
Right.
valuations are generally done with, there's always an agenda with the valuation. In Mitch's case, I love that story about the dot-com days. I was around for that too, and it was amazing. People just had an idea, and they would raise a whole bunch of money, and have lobster Thursdays and massage Mondays, and it was crazy. And me being a conservative accountant, we'd shake our heads and say, "What's going on here?" And they measured their success not on their revenue. What sales? There was no sales. It was all equity, tax-free money coming in to fund their fun idea and lifestyle. But valuations are done with reasonable assumptions based on a certain agenda. It can be to get an investment from somebody that is going to give you that needed influx of capital, in this case, $500,000. It can be done for figuring out how to maybe sell your company to a competitor. It can be done for figuring out how to maybe give shares of the company away to your family for estate planning. And each situation has a different agenda, but valuations that can be respected by whoever's looking at them need to be done with certain reasonable assumptions.
Right. Yeah, that's great. So wise words. By the way, so we will have a question and answer session starting in a few minutes. And so if anybody wants to ask something live, I know there's a bunch of questions in there, but if you want to ask something live, just raise your hand and then we'll call on, kind of raise your hand on Zoom and we'll call on you. Also, I dropped that first survey that I kind of that came from our sponsor. I dropped it in the chat, so hopefully you had a chance to answer it. If not, just scroll back up if you can. There will be a final survey one survey question that we will get to probably in about 3 or 4 minutes. So just keep that in mind. So Mitch, Robert, you have seen a lot. You have been around a lot. I want to talk about some kind of best practices Mitch, we'll start with you, kind of best practices from a finance perspective when it comes to, early stage, middle stage, late stage. It almost doesn't matter unless you think it does. What are some best practices you can share that founders should be thinking about when it comes to finance?
Well, the one of the courses I taught at Rutgers was advanced financial management, and that was on the graduate level. And the first class, what I always told my students was make believe the outside capital you take in, whether it's loan from a bank, loan from an individual or a fund, or an investment from an individual or a fund, make believe that money's your money. How would you feel if you didn't get timely reports? How would you feel if the accounting reports you got, the P&L, was not done to form, right? Wouldn't you be upset? If you're going to go down the road of entrepreneurship, you've got to make believe that these people are, in a sense, your teammates, because they are, right? It's not like you're a public entity and they're going to their broker and saying, all right, buy me 5,000 shares. They are making a bet on the idea, the product, you as management, right, and future profitability. So you're stuck. If you're going to take outside capital, you owe these people, and what you owe them is your best shot. And the way you take your best shot is by being super professional. And if you don't have the skills, bring in someone who does. Go talk to someone who does. There's all kinds of, free information available these days on the internet. Towns have courses. I give a lecture in my town, twice a year on advanced financial management. It's out there. Make yourself smart. you want to be smarter anyway if you're going to do this and make a profit.
Yeah, right on. Right on. I agree with all of that. That's great. Robert, same question. Best practices
Yeah.
for tax. We'll leave it at that.
Well, okay. So for tax, usually when someone's starting a business, taxes are important, but maybe not absolutely immediately important because there's going to be some period of time where you're not making money. And so before you get to that, you need to have a plan and make sure that this, if I'm talking to somebody who's starting up a company, I want to make sure I see their plan, that it makes sense, it's been well thought out, that they've done some projections for what they feel like it's going to cost them to get this thing going, what their cash flow is going to, what their cash burn is going to be, so they have the right capital to deal with the startup costs. Most businesses that start up fail because they're undercapitalized. So you really need to make sure that's understood, and make sure that they have a good lawyer and a good accountant that specializes in their industry so that they can give them advice on helping them to avoid the pitfalls of what they're going to do as they start this business. Structure, that's choice of entity, LLC, S corporation, C corporation. Let's talk about where you're going and what kind of entity makes the most sense. Registering the company the right way, getting an EIN, getting the proper insurance, having a good bank to deal with and having a bank account and a credit card that is actually in the name of the business. So many people will start a business and work it out of their own personal checking account. And that's not the way to start a business. As Mitch said, you got to follow the rules and be a real business. You can't be half a business. You have to be a whole business, and have an accounting system that gives you the information you need to run your business, to plan for your profit, the taxes that are on your profit. And if you have investors, to report back to them in a credible way so that that you can continue to have a good relationship with the people who have the confidence to invest money in your enterprise. So those are a bunch of things that I would say would be best practices for founders.
If you don't mind, David, I have one more.
Yeah, please go for it.
And
Go for it.
and I'm always shocked at how many people jump over this one simple step. You ready? Go get a business card.
Business card, what's that anymore, right? No, I still have
No,
them for
I'm telling
sure.
you, go get a business card.
Yeah.
You go to a conference and there's the successful people up speaking to you, and you go to the cocktail party afterwards. People are exchanging business cards. That networking can be immensely profitable to a young business. The people aren't going to write down your Gmail address. Trust me, right? They'll give you a business card and say, "Send me your contact info." And when you're out raising money and you're sitting in a room and there is this wealthy person with their advisor and maybe their lawyer, and you say, "Well, okay, my Gmail address or my company email address is this." No, print. It costs $15 at Staples. Print a couple of hundred business cards. It's hard to believe how important that is.
Yeah, I agree. I totally agree. We cannot lose the personal connections that we've made. It's really important. Okay, we're gonna switch to kind of Q&A. So if you have a question, raise your hand. I just want to say again, thank you to our sponsor. One final question from them. I'm putting it in the chat. Just click on that. And it's a quick question. Do you remember the name of any company or tool mentioned that helps people build or rebuild US credit? Yes or no? So please take a moment and fill that out. And we thank you to our sponsors. Anyway, anybody have any questions that they want to ask live? Please put up your hand. Robert, there is something in the chat that I'm kind of curious myself. Monica, we'll get to you in a second. Someone wrote here, if my company receives an SBIR grant, I think, Robert, you might know what that is, from the government, right? A grant from the government, even if you don't know what the SBIR is, does that company need to pay tax on it? So do I need to pay the question is, do I need to pay tax on grant money that's received by a company?
That's depends on the type of grant. I don't know the answer to the specific question, but some grants are not taxable. Some grants are taxable. And usually it's very straightforward and it clearly indicated in the paperwork that you're signing when you get that grant.
Yeah, that's right. Thank you for that. Monica, did you want to, I think you had your hand up. Did you want to ask a question?
I can. Thank you so much.
Go for it.
I
Let me find you. Where are you so I can, oh, you don't have your camera on?
I don't.
Okay, that's okay. Go for it. Ask your question. I just was going to spotlight you. That's all. But go, ask your question.
So I recently was introduced to this like business, like a social entrepreneurship, and I took a workshop. So I'm kind of rolling that out. Are you familiar? And I'm just trying to figure out the best like structure or entity to set up the business as. So it's not a nonprofit, but it's like established to like help and support the community. So like a nonprofit, like outcome, but it's for profit. It's called a social entrepreneurship venture.
Yeah. Robert, Mitch, you want to comment? So basically which has become very popular in the last, 10 to 15 years, entities that, are doing social good, if you will. And so, yeah, curious if you have any thoughts.
Most nonprofits are corporations
That's right.
by nature. They just happen to be a nonprofit for tax purposes. If this is a socially minded enterprise, it's probably going to be a C corporation, and it may eventually morph into an actual nonprofit. But it sounds like the mission is not just about making money, but about doing good, and it probably should be a corporation, a regular C corp. What do you think?
What do you think, Mitch?
Tiki froze.
Mitch, do you froze on us now of all time? Okay, we'll wait for Mitch to get back.
Okay,
Gassen. Oh, go for it, Mitch. Go for it.
yeah, I'm sorry. The I would say you definitely want to be a C Corp because there's all kinds of governmental grants available if you've got a real strong social purpose.
Yeah. Okay, great. Gassen, what is your question? Let me unmute you.
Yeah, sure. My question is, I have in my company. I'm registering in many country in the United States, and had to be register them in with Texas, like Miami and Hollywood, Florida. And thank you so much for inviting me in that meeting. And I'm so glad to be in here. I am first of all, I'm present myself. I am president and owner company design graphic architect future technology is begin I founded my company since 2019, and my company is registered with the government Singaporean, and of course I have in, many partnership and around the world with many company, and that's why I'm asking uh, how to be register my own company in city United States.
Okay,
That's
so I think I kind of got the question. So Robert, it sounds like he has multiple companies around the world, but is looking, but possibly also is looking to start up the company in a particular city in the United States. I heard Hollywood, Florida. I heard Texas or something like that. So I think maybe he's looking to see maybe if how to determine one state over another is what I gathered.
Well, I think when you're choosing where to do business inside the United States and choosing what state that might be, I think you have to think about two things. It's what state is the best place for you to be doing business. Forget about taxes for a minute. Just where should you be operating from, which is going to help you be the most successful business you can be. And then the other question after you've answered that one is, what are the tax consequences of those choices? So you might pick that, you might get to 3 different states that make the most sense operationally for you. And maybe one of those threes has a lower tax rate than the other two. And that's the choice that you would make at that point. That's how I would make the decision.
Yeah, I would agree. Okay. Thank you for your question, Gassen. Servains Wilson, do you have a question?
Yes, my name is Sylvanus Wilson with the Isaac Institute's consulting and design firm. We work with a lot of SMBs as well as solopreneurs. And one of the questions that I get asked the most is if you are planning to scale and go from, let's say, LLC to S Corp or C Corp, what financial accounting software would you recommend that will allow and be accessible to someone that may be starting out as a solopreneur or small business, and but it would allow for that scalability when they are ready to turn into a publicly held company.
My answer would be, thank you, good question. My answer would be that QuickBooks is the number one and best software that I can think of. I think 99% of my clients use it. And that's for the full gamut of clients, whether it's a startup, a 1-year-old business, or a business that's expanded, 100-fold. It's really hard to outgrow QuickBooks. It's an amazing product, and it's totally scalable as your business grows. There's certainly some much more robust software out there that is a little bit more difficult to use and certainly a lot more money, and they're fine products. But I would say at this stage of the game, QuickBooks is a no-brainer.
And to add to that, what if they're doing their taxes themselves, starting out before they move on to CPA or anything of that nature, do you have a platform that you recommend for that as well?
Well, I mean, individual tax software is the most common one that everybody knows about is TurboTax. That's also an Intuit product, the same company that owns QuickBooks, and they actually talk to each other pretty well. But that's on the individual side. On the business side, I really don't have a lot of experience in that area because I don't really have clients that do their own business taxes. They use me. But there's, you could probably look at that in Google and figure that out pretty easily.
Awesome.
Thank you very much. Thank you.
Thank you, Servains. Last question, Yashua. I want to make sure I pronounce it right this time.
Joshua is perfect. Thank you, friend.
Awesome.
So I work with a lot of small businesses. Again, I'm a financial advisor. I'm curious though. Now, I have 2 individuals in mind that, of course, don't have any sort of funding besides selling their work. One does arts and crafts. The other is a small, wants to be a restaurant owner, right? But it's not quite there. If we're talking about possibly getting funding for them to advance their careers, what kind of in this case, 2 things. What kind of income should they have right now to consider S Corp versus C Corp if they were to go on that end, or maybe just sole proprietorship LLC? That's fine as well. What thresholds should they meet before they should really think, hey, I should go for something bigger, C Corp or etc.? I know with S Corp, you can get private placements, so you can have your own private fundings, but there's certain limitations on that end. C Corp is public, but I'm sure there's money that has to go into it, time and effort, work, etc. So that's all in consideration. So how would you go about helping an individual who is living paycheck to paycheck for the most part, but maybe they want to get funding down the line?
Well, if I can just say one thing, C Corps don't have to be public. Let's make sure we all understand that. C Corps can be private, right? So, but to me, the defining element is how far do you want to take this company? Right? So if you want to open a restaurant and you're going to, have it be in the town where you live so you don't have to move, and, you're hoping that by the end of the year, 2-3 years down the road, you're making $100,000 to $200,000 a year. You don't need to be a C Corp. If you're saying, look, we're going to be the new McDonald's and we want to have 2,000 restaurants in over the next 10 years, yeah, you better be a C Corp. So in the two instances you talked about, like I have a hard time conceptualizing how an arts and crafts business could expand to a point where it needs to be a C Corp. And there, the owner might be better off with a pass-through entity, right? But with a restaurant, again, same thing. Unless they're going to wind up opening 5 restaurants in neighboring towns, then you might want to be a, you might want to be a C Corp.
Robert, any perspective on that?
I think if the answer is about if the consideration is about managing taxes, you have to look at the numbers. When I'm talking to somebody about that question, what entity what choice of entity should I have? I always ask them, what's your profit going to be this year? What's your profit going to be next year, the year after? And based on the answer to that question, I can run some models on what the taxes would be in each type of entity and come up with the best result. And based on just taxes alone, give the answer to which type of entity would be the best result. If there's more to the question other than beyond taxes, that's a different story. But from a tax perspective, usually I'm asked to look at it from a tax perspective.
Okay.
Awesome.
Thank you. Yeah, I'll take it.
Joshua, you good?
And one more thing, Mitchell,
Okay.
fellow Scarlet Knight.
I'm
Very
sorry.
nice. You're a Rutgers alumni, so good to see
Well,
another
no,
alumni.
I'm a Rutgers employee, not an alumni.
Yeah, that's fine. Thank you, guys.
Same difference, right? Thank you, Joshua. Thank you for your question. So, final words before we end. Robert, Mitch, anything? Well, first of all, how can people get in touch with you? And then also some final words. So Mitch, we'll start with you. Any kind of parting words you wanna leave for everybody, and also how can people get in touch with you?
Okay. Quickly, I think this is a great time to try and gear up something you've always wanted to do on it from a business perspective. There's a lot of capital available. The banks are more willing to take risk on small business loans than I've ever seen them be willing to do before. So if you want to do it, now's not a bad time to do it, right? And people are willing to do business with small businesses and startups, whereas before they wanted established brands. So there again, it's a good time to try it. Just make sure you drive on the right side of the road, that you stay between the lines, you operate professionally, and you seek help. There's nothing wrong with failing. If I can leave you with anything, failure is inevitable if you're running a business. It's what you do next that defines your success.
Right on. And Mitch, how can people get in touch with you?
Probably, well, my email address is last name, first name, but truncated, filet Mitch at Gmail. But the best way to find me is my cell phone, which is 240-888-8778. Text me, we'll set up a call and we can have a chat. 240
Awesome.
888 8778.
Yeah, if you want to chat it, that would be great too. Thank you so much.
Sure.
Robert, so I just saw you shared your email. I appreciate that. So that's how people can get in touch with Robert. Any final words for everybody on the call?
Well, as far as that's concerned, I think I gave you a lot of advice about planning and getting the professionals and acting like a business and all the things I mentioned in what a founder should do. But I think what really is important is to make sure you're working with experts and make sure that you're working and getting advice from everywhere you can. The universe is filled with good information. Be a sponge. If you're an author, join the Authors Guild. If you're somebody in the construction business, get involved in a construction association. Get to know your peers. Yes, they could be your competitors also, but they've all been where you are, or you may have been where they're going, or likewise, vice versa. You can learn from your own mistakes. You can learn from other people's mistakes. You can learn from their successes. So definitely hang out where people are that you are like and learn from them, whether it's in an association or with your lawyer or your banker or your accountant. Make sure you're working in a circle of people that understand your business and can teach you something new every day.
Amen. Love that. Thank you, Robert. Thank you for sharing that. Thanks, Robert. Thanks, Mitch. Thanks to all of you that came out to support. We hope you enjoyed. We will be back for another entrepreneurial strategy series at the end of March. And so this was recorded. And so everybody that's registered, we had about 400 registrants, so everybody will receive it. And so you'll get a recap email. You'll get some information on how to get in touch with Robert and Mitch or myself or Stephen, and we're here to help you and kind of guide you on the way. And so again, thank you so much to everyone. Thank you for joining, and we'll see you soon. Take care, everyone.